Morning, good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. I think we should kick off today's discussion with a readout from both Fernando Valle and Salih Yilmaz, who've just been conducting a marketing trip through the Middle East broadly. But quickly on the call, we'll just go around the world. We got from his usual perch, Salih Yilmaz in Dubai, Patricio Alvarez joining from London, and Fernando Valle joining from 731 Lexington. So give us a sense of the vibe, gentlemen. How are things looking when you kind of reflect on the time you had last week? Fernando, we'll come to you first. I think it was your first trip to Dubai, if I'm understanding correctly. So what did you talk about to clients? Were the interests the same as you hear as part of your discussion in New York? And give us a sense of your take from the region.
Yeah, I think it's really the region is buzzing, and especially in Riyadh, I thought there was so much movement and excitement. And when you see the discrepancies in Dubai, Abu Dhabi to Riyadh, you see just how much low-hanging fruit there is in that market. One anecdotal evidence is every Uber in Dubai is a Lexus or an Audi or what have you, and then in Riyadh they are Hyundai Sonatas pretty much everywhere. And so that and considering just the amount, the population, the wealth in Saudi, we expect to see that transform over the next decade or two. As far as clients, we did a couple events, and mostly, surprisingly to me, very similar conversations. I think a lot more receptiveness to renewables in the center of the oil world than I would have expected. We met with ADNOC Distribution. They are investing heavily in renewables. Saudi obviously talking a lot about installing solar to reduce their crude burn. And I think there are challenges still to developing that market, but they're really living the ethos of having both of them and having a basket approach into the region of all kinds of energy. We also surprisingly got questions on nuclear and hydrogen. Hydrogen probably a little bit more challenging just on the technology side, but there's really questions on the transition and where do we go from here and the next steps. So I think it's a very interesting region. Obviously, I come from a developing market. I've seen some buzz, and I don't think I've seen anything quite as exciting as I did in the Middle East this time.
Fascinating. Okay, Sally, let's come over to you. I love the fact that Fernando describes this all of the above mentality. I certainly think that's true here in North America as well. But give us your sense. What is the vibe of the conversation like at the moment? And obviously, real estate, everything else in the region really hinges on what's going on with the oil market. Are folks comfortable with where we're at the moment? And what kind of questions were you getting on the trajectory of crude oil?
Sure. I mean, I'll talk about Riyadh because it was my first time in Riyadh in a year. And as we were discussing just before the call, it's very interesting to go back to Saudi Arabia because every time I go back, it just looks very different. It feels very different. And some of the differences are, I mean, of course, there's the social side. I mean, the country is changing and modernizing very fast. On the social side, I was talking about the dinner we had after our client meetings, and there were some tables that were mixed, which you wouldn't see just a few years ago, but you do now. And then in terms of the boom, when we were going around in between meetings around Riyadh, I mean, there were so many cranes, and it just reminded me of the early Dubai days when there was just this construction boom that's clearly that Riyadh is clearly going through now. And I think you do make a good point about the oil price. But obviously, all of this does depend on the oil price. Currently, I mean, oil prices have come down a little bit from the levels we saw in the last couple of years, but it is still at relatively healthy levels for these countries to go ahead with their diversification plans. One thing that I will mention, while we were on the road, we had a couple of headlines about Aramco that I think were quite interesting. One was that their plans of a potential share sale is back on the table, and I think the main reason for them to be doing this is to fund their diversification efforts. They have the Vision 2030, and you can really feel that buzz, and you can really see the country is really trying hard to diversify as quickly as possible. And the other one was that they decided to actually halt their plans to increase their oil production capacity from 12 million barrels per day to 13 million barrels per day. And I can go on to talk about some more details on this, but I think essentially the reason they're deciding to do this is, I mean, they're producing at 9 million barrels per day right now anyway, way below their capacity. And they think spending 20 to 25 billion dollars to expand their capacity is probably not the best use of their resources. But then the point is probably that capital, those savings, will be redirected into diversification efforts. So all in all, I mean, while we were on the road, while we were seeing what's going on in Riyadh, these two headlines, I think, spoke for the endeavors that the country is taking to diversify away from oil as quickly as possible.
Okay, Salih, I think we're going to swing back around on just some of those questions, but Fernando, over to you. Sorry.
Yeah, just one quick addition, which I thought was interesting, was that while we were in Riyadh, there was a very clear directive that anyone that's in the Middle East should have their headquarters in Saudi, which I think is a very relevant point because they're not hiding at all that they want to take things away from Dubai and Abu Dhabi and into Saudi. And obviously, over twice the production, 6 times the population, much bigger land mass than the UAE. There's a lot of potential in Saudi to do that, and I think that could have its knock-on effects in both the UAE, but also into the cohesion of OPEC over the long term. So definitely something to watch over the next few years.
Yeah, very much interesting to watch the sort of relatively friendly rivalry unfold there. Patricio, I want to come over to you and tie this concept of energy transition into the discussion. I think it is true that energy transition is a global phenomena, and there's this almost ethos of 2 steps forward, 1 step backwards, and kind of finding all the right fuels and technologies. I would note that in Europe, you've got a react out just the other day on RWE, and this idea that Germany is going to be building presumably some additional natural gas fired capacity. So tell us where fossil fuels are at in that energy transition mix and what it means for a company like RWE.
Sure. So our react was on the long-awaited decision to start the tender of 10 gigawatts of gas-fired capacity that's supposed or expected to come online by the end of the decade. That makes it the largest auction in over a decade in Europe for gas-fired power plants. So it's a meaningful sort of regulatory event or policy event, particularly because that comes right almost a year after Germany closed its last remaining nuclear reactor. So it's that, and also the fact that switching to flexible gas generation is now the only option really for Germany to wean itself off its dirty coal habit. So it will serve to offset the closure of its lignite fleet, which ranks amongst the largest in Europe. So what that means for RWE is that we see the company pushing forward and trying to win some of those gigawatts for the build out along with Uniper. And what that does, aside from perhaps building an extra revenue stream that is quasi-regulated, given that it's going to be under a capacity payment system, which tends to be favored by utilities, given that you get paid no matter if the plants are running or not, you still get that capacity payment. But aside from the earnings angle, it also builds or gives credence to the company's phase out goal. Let's not forget that RWE is one of the largest coal-fired producers in Europe, but at the same time is also one of the fastest growing renewable power developers. So this sort of regulatory development improves the visibility for that careful balancing of closing out the lignite fleet and expanding renewables, but at the same time affording flexibility via natural gas. I think the other part that is important to highlight is that the provisions in this tender have been changed to push back the dates for the hydrogen switch. So these plants were supposed to be hydrogen ready from the onset, and the tender was supposed to happen roughly a year ago. But due to basically a political standstill, the date for the hydrogen switch was pushed back. And there was also the introduction of a provision where it says that other forms of abatement can be utilized, meaning that it opens the door for carbon storage as well for some of these gigawatts at least. So it kind of shows you that that although you can say that Europe is further ahead on the energy transition pace, just because there's more renewables and less fossil fuels, there is some political risk tied to it, and also slow-moving technologies such as green hydrogen and carbon capture, which are not built at scale yet, make the transition quite, it may make or cloud sort of the transition pace for the rest of the decade and probably 2040 as well.
Okay, I want to follow up and ask a question on Ørsted. For anyone who doesn't have real-time alerts set up on the folks who participate in these calls, and we're constantly putting out research and analysis, and particularly around earnings. And so I believe Ørsted reported today, I just see on the wire just a few seconds ago, Patricio, Ørsted's renewable build-out must offset waning gas price boost. Tell us what we heard from Ørsted and what's going on there. How does it fit within this narrative?
Sure. So one good way to introduce Ørsted is that's the poster child of the offshore wind crisis in the U.S. So Ørsted had outsized exposure to a couple of projects in the U.S. that were canceled, or the company needed to withdraw from them before reaching a final investment decision, and that led to billions worth of cancellation fees. Bringing into question not only the company's exposure to a still maturing offshore sector, but also perhaps the financial management behind the company, or sort of the funding strategy for the company. So that made the strategy update today very, very key in sort of dilucidating or giving more visibility over the outlook. And it wasn't far from what we expected, and I think it was expected by consensus as well. The company had to pare back spending by almost a third. The company also pared back its end of decade renewable capacity goal from 50 gigawatts to around 36.5. So it's quite a big drop. What that means for the earnings outlook, it means it will take the EBITDA expected annual gains of 14% in its previous plan to around 8% this time, which to us really it's like the company has hit the reset button and is trying to rebuild investor confidence. And while these targets look credible and should stabilize the balance sheet over the next few years, it will be a question of waiting and seeing if the company can execute on the rest of that pipeline. The company is still offshore focused, which tends to be a higher risk segment versus onshore wind and solar. So we are taking sort of a wait and see approach to see if the company actually starts to meet those goals, those new set of goals that are a bit reduced or significantly reduced versus the previous plan, but nonetheless look credible.
Okay, Fernando, I want to come over to you, tie it back into the conversations you were having last week. So first, I'm curious, were folks in the Middle East interested in what the U.S. oil patch was up to. And while you were over there last week, I think both Chevron and Exxon reported. So give us a sense of what earnings look like and your outlook for both those companies.
Yeah, absolutely. So starting with the latter part, I think on the first part of your question, on the transition, I think there's a lot of interest in both. First, solar, just obviously because of the location. Although there is a challenge, with silt and the effectiveness of solar panels over time because of all the buildup there, especially in Riyadh. It's a desert after all, but it can be a relatively successful part, and that's how Aramco expects to increase their exports by up to 1 million barrels a day over the next several years. And then there's some interest in hydrogen, but it's a little bit more distant. And lastly, in nuclear, although nuclear is obviously challenged because of the volatility in the region and the challenges of getting the U.S. to agree to anyone having enrichment capabilities in the Middle East. Going on to the shale patch, I think that was probably the area where we got the most interest, because there was, I think it's almost interesting that the same opacity that we have with OPEC, they seem to have with U.S. shale, despite it being public and outside more open than OPEC. I think they see it as just rampant growth that defies logic almost. And our view is that growth is tapering off a little bit amid cost inflation, higher interest rates, and then consolidation within the shale patch. And that was pretty much well received. I think, as Salih mentioned, the decision by Aramco to not raise their capacity by 1 million barrels a day is reflective a little bit of the challenges with demand, and they are seeing that as well. So I think that was well received and a relief for them of sorts. And that takes us into the earnings of the two majors. Overall, they were very solid results. I think Javi Blas had mentioned that they're pretty boring and as expected, and they have been pretty much for the past 3 or 4 quarters. It's been an area where refining is contracting, and it's likely to continue contracting over the next several quarters. Again, demand being the biggest issue, but they're generating significant free cash flow. Dividends are very well covered for all the majors in the U.S., I should say, at least. I think the Europeans as well, but Will's better at those. And then the buybacks, for the most part, they can cover the buybacks at $75 to $80 Brent. It depends obviously on chemicals and refining margins as well, but let's say that at $80 Brent, they're not complaining at all, and they can continue to deliver substantial free cash flow and share buybacks. We're coming up on Chevron's Analyst Day. Exxon stopped doing them apparently last year, and we'll see if there's any significant shift to the strategy. Obviously, there's a little bit with Hess whenever that deal closes that they're going to be a bit more deep water focused than they had been. Prior to Hess, they expected to spend up to 75% of their growth investments in shale, both U.S., Canada, and Argentina. That's likely to decrease substantially, the proportion at least, with Hess coming into the mix. And I think that's a positive because, again, shale being full cycle, repeated full cycles, when you have higher rates and cost inflation, you wind up being a lot more exposed to the rates and to cost inflation as a shale producer than you do for longer life projects where your fixed asset is fixed at the beginning and then your lifting cost is very low. So Guyana, especially because you've already essentially your fixed cost is going to be whatever the implied value of it will be in the Hess acquisition, you're going to get a very significant free cash flow for years to come.
Okay, thank you, Fernando. I want to highlight a couple of reacts that we've had out. Again, our reacts are sort of very rapid fire response analysis, earnings, guidance, new CEO, any kind of sort of big announcement related to a company. We try to push those out. So if you haven't been watching The Wire and you kind of want to think, if you're thinking about energy transition, Vestas, the world's largest wind turbine manufacturer, they reported earnings this morning, and the stock is up over 5% and change here at the moment. We've got a react out. Very interesting set of numbers. One of the things I fixate on is that they had a really interesting 4Q in terms of order intake, took in over 8 gigawatts worth of projects. And so that suggests that they're really building out a pipeline for continued growth in the future. So despite some of those negative headlines that Patricio can talk about related to the offshore wind business, Vestas seems to be on a reasonably good trajectory in terms of building out their order book and really getting back to a growth story. They also have an improving margin that's quite a turnaround for not just them, but the whole wind industry. Margins got compressed primarily because of high steel prices and supply chain issues that they were wrestling with over the last couple of years. We also put out a react on Enphase. Enphase is an inverter manufacturer, so very kind of keyed in to what's going on with the solar industry. Their stock is up about 15% here at the moment today. Quite a volatile space if you're looking at the daily movement in share prices. We also have a react on them. Very interesting. They've been in a very bit of a sort of difficult period. 4Q wasn't very good in terms of top line growth. 1Q guidance is relatively weak, but I think they really set the stage for a recovery in the demand for their product. The residential side of the solar business has been a bit challenged because of higher interest rates here lately, but I think they're working through all of that. And if you haven't seen the sort of top line numbers, global solar demand grew over 70% last year, just almost mind-boggling, even though the residential piece was a bit challenged. So take a look at our reacts. Salih, I want to come over to you because I know you've got several reacts out here recently, and I think probably the one we should start with, I think you already mentioned it, but I know you had one on Aramco's share sale, but tell us about a little bit more about what's going on with Aramco, and I know you've got a couple others, so feel free to pick one or two and group here what's going on with some of your names.
Sure. I mean, as I mentioned, we had a couple of announcements by Aramco that the read-through for me was that they are just channeling more capital into diversification. And one of these news was that they're halting their plans to increase their oil production capacity from 12 million barrels per day to 13 million barrels per day. And as I mentioned, they're probably looking at the demand picture in the near term, and it's not looking great. And there is abundant non-OPEC plus supply out there. So there are these OPEC plus cuts that's keeping their oil production way below capacity. And they're probably going to be extended into the second quarter, probably into the second half of the year as well. And I mean, increasing production capacity by 1 million barrels per day is a very expensive thing to do. I mean, it would take, the estimate was, I think, between 20 to 25 billion dollars. So at a time when their production is limited at around 9 million barrels per day, using that much capital to increase their capacity now probably didn't make a lot of sense, and that doesn't really make sense to us either. So it's probably a prudent strategy, at least at the moment. And I think an important point is that this is obviously a reversible decision. I mean, in 3-4 years' time, maybe even earlier, if the demand picture is much better, if all the supply growth that we've seen outside of the group, outside of the region, doesn't materialize, they might be in a position where that makes sense again to increase their capacity. But right now, they think it's not the best use of resources, so they're halting those plans. And then again, those savings will probably be redirected into the Vision 2030. The other one, again, this is at early stages, and this is something that we've heard about before, is the potential share sale in Aramco. it was on the table, it was shelved, it seems to be back on the table, and it's, I think, again, for a very similar reason. It would be to fund the diversification efforts by the kingdom. I mean, why now? Oil prices are probably below their fiscal break-even price, but still, I mean, an oil price that's around $80 a barrel for Brent is a pretty good level for them. And in terms of valuation, they have a valuation that's above the US oil majors and the European oil majors. So that's on Aramco. Very briefly, I actually only had OMV reported last week. That's within the mid-size integrateds that we look at. It wasn't as big of a beat as the 2 US majors and the 2 European majors that we saw. I think Exxon, Chevron, BP, Shell all had pretty good results, very good market reaction to their results. I think for OMV, as Fernando mentioned, refining margins were down, realized prices were down, and I think most importantly for them, since acquiring Borealis, the chemical segment is very important for them, and the chemicals business has been under a lot of pressure given the very weak macro environment. But that being said, so you would have thought that's a bad quarter for them, but they did actually increase their dividends to a record level. So it just goes to show, I think, that it's boring. It's gradually normalizing in every business segment, but still these companies are generating enough cash to cover dividends and even increase dividends. So I thought that was interesting about OMV.
You know, one of the things that I am surprised that you haven't mentioned yet across the board here is the political decision from here in the U.S. from President Joe Biden to pause the LNG permitting approval process. Now, if for anyone who missed that conversation last week, Patricio and I and our colleague Talon Custer, who's really focused on some of the LNG exposed names, went deep on this topic. But I know everyone in this group has companies exposed to what's going on there. So I'm curious for you, Fernando, how did the Exxon Chevrons of the world respond to that? Did they even talk about it on the earnings call? And what do you make of the decision? Is it just politics, or is it something that you're concerned about that the U.S. could actually slow its export process there?
My view is that it's just politics, and I think most of the Texas is probably feeling the same way, given it's an election year, and also the actual studies that were cited to back up this decision are laughable at best. So I think it's political, something that may be reverted even before the election. It doesn't conform with energy policy, it doesn't conform with foreign policy. It just makes absolutely no sense to bar LNG. The study says that LNG is, I think, 200 times worse than coal for global warming, and in fact, we've seen natural gas and LNG being a big part of that. Part of it has been critical in reducing global emissions. So it was a study that it keeps also getting revised downwards to be like, oh, actually we had it wrong. It used to be 5,000, then 2,000, now it's 200. So it's just not the best study. I think it won't change any of the projects already underway. It really could potentially cause a delay for projects that need those permittings, but there's a lot of work that can be done before you actually need the permit, from engineering to contracts to financing work that can be done in that period. And I fully expect that this will be reverted probably before the election, but if not, sometime next year.
Okay, Salih, I'm curious to get your view from the region. Do the Middle Eastern producers continue to see LNG as a growth opportunity? What do they think about competing with the U.S. and what's their mind on this kind of decision making?
Yeah, I mean, Qatar is the big LNG player in the region, and they're already producing quite a lot, and they are expanding in LNG. For Saudi Arabia, it's early stages. I think they do want to increase their natural gas production, but at the beginning it would be more for domestic use. But LNG could be something for them to consider in the long term. So yeah, it's I think Qatar is the biggest competitor, biggest producer, and biggest competitor from this region globally.
Okay, Patricio, I want to come back to you on this idea because even though we discussed the implications for the European gas market last week, we've got this development from Germany that you've already talked about. I'm curious if Germany indeed goes out and builds 10 gigawatts worth of gas-fired power plants. What does it mean for gas demand in the region? I think last we spoke, you generally see this idea that European gas demand has peaked. Is that still true? And where do these kinds of decisions that policymakers are making feed into your outlook?
Yeah, definitely. So I would have to caveat that we haven't really worked out like a long-term forecast of how the 10 gigawatts would impact the demand levels by then. But just thinking about the structure of demand at the moment is that there's 1/3 of gas demand, roughly speaking. 1/3 goes for power generation, another third for heating, and another third in industrials for industrial activity. Taking that as the baseline, we do think that the sort of the lever where most of the gas demand destruction will come, the sector for that will be the power sector, just the renewable build out. The European Commission and Germany as well obviously remain committed to almost tripling renewable capacity by the end of the decade. And though we have talked about how utilities in the region have pared back their planned capacity additions for the next few years, they are still on track to increase capacity additions by about 15% this year versus last year. And that's despite all of the offshore woes, the delays, the permitting delays, the lackluster awards in the UK last year. This just shows that there's still a lot of the renewable sector is not dead yet. It's still building a lot of capacity within Europe. So we don't expect it to sway the overall trend in gas demand over the long run because electrification, both in heating and also in industry, should pare back gains in those sectors. And obviously, the gas demand for power is poised to decline substantially by the end of the decade.
Okay, thank you, Patricio. I think we've run past our time, so that's a great stopping point. Again, I'd like to thank everyone for joining us today. We are holding a number of in-person events coming up. So next week, Fernando and I are going to be in Miami. If you want to meet us in person, whether you're based there, you want to fly in, come join us. We're getting together on Tuesday there with some of our colleagues. We're going to have some discussion, somewhat like this, but we're also going to sit at the table with you, go out for a drink afterwards. So come join us in Miami next week. Fernando and I, plus a number of other colleagues, are also going to be in Kansas City April 2nd and 3rd for another event. We'll get you the details on that if you want to come and see us in Kansas City. We're going to have a really fun discussion there, and I am sure that within the next few months, we will also host events in New York, London, and elsewhere. So stay tuned for all of that. We want this to sort of have a virtual community, but we're also keen to say hello to all of you in person whenever the time permits. So again, thank you for your time. Shoot any one of us an IB or an email if you want to follow up on any of the specific discussion here today. Take care, everyone, and hope you have a great rest of your week. Cheers.